Hello, everyone. My name is Ashley Rose Johnson, and I'll be going over financial and capital budgeting for small businesses. Our agenda includes starting a business, legal requirements, financing a business, sources of financing, profitability, and the break-even analysis, financial planning goals, capital budgeting, and the types, uses, and effects of capital budgeting. Let's begin with the first steps of starting a business, starting with the business plan. The business plan will help to summarize the company and provide information on how you plan to evolve the business. Second, you'll need to assess all finances. Starting a business can become costly, so it's important that you determine how to cover these costs. Next, to become an official business entity, you must register with the government. After registering with the government, you'll need an Employer Identification Number, or EIN, from the IRS. Since owning and starting a small business can be a lot of work, it's important that you build a great team. You should put the same effort into your employees as you do with your product or with your service. All of the roles and responsibilities should be clearly defined. Another important factor in starting a small business is choosing the right vendors. It's important to build a positive relationship with all vendors since you will be working a lot together. You need to be able to trust that they will help keep your business fully operational. It is also important to begin branding and advertising before your company starts to sell the product or the service. By building the brand, you will create a following of people who are waiting for you guys to open doors for business. You will need a logo that will help consumers easily identify your company and social media account to help spread the word. Lastly, the initial launch and first few sales are only the beginning. In order to hit the break-even point and turn a profit, the business must be in constant growth. This means you should be prepared to adjust at all times since the market is always changing. Let's dig deeper into the development of a business plan. Start with naming the business. Some might consider this the toughest part, and your name might change numerous times, but when it feels right, it will stick. Next, the executive summary. The summary is a company description, the problem the business is solving, the solution, and why you're starting now. The summary should also include what kind of business, what does your industry look like, and what will it look like in the future. You should also create a mission statement explaining the purpose and principles your company will abide by. Moving on to market strategies. Ask yourself, what is your target market, and how can you best sell to that market? Next is your competitive analysis. What are your strengths and weaknesses in your competitors? How will you beat them? Design and development plan. What is your product or service, and how will it develop? Then create a budget for that product or service. Operations and management plan. This is basically, how does the business function on a daily basis? And lastly, finances. Where is the money going to come from? When is it going to come? And how will the money come? What sort of projections should you create, and what should you take into consideration? In order to be successful in financing and capital budgeting, it is important that your business meets all legal requirements. Choosing the proper business entity is important because it affects your personal liability, tax payments, fundraising ability, and more. These entities include a sole proprietorship, general and limited partnership, C Corporation, S Corporation, or a limited liability company, LLC. Depending on where you decide to open the business, there may be specific licensing or permits needed from the country, state, county, and or city. For example, a local business license, building permits, health and safety permits, fire permits, and home-based permits to start. It is very important that your business is compliant with the laws in your area. Next, in order to separate personal finances from business, it's important that you retrieve your EIN. This can be requested from the IRS over the phone or by online application on the IRS website. Normally, startup companies are concerned about keeping their expenses down, so they neglect to hire legal counsel. It's important to remember that proper legal advice could potentially save your company thousands or even millions of dollars down the line. Having any legal trouble can be detrimental to your business. As a family business, if you plan on operating with multiple business owners, it's important to make sure that each individual recognizes and understands their rights and responsibilities. This can be done by getting all agreements made in writing. Let's move into financing a business. A vital part of starting a business is how you obtain financing or raise capital. Bankers and investors are the supplier of funds. There's a significant difference between the two. Bankers and other lenders increase your debt with debt financing, while investors provide equity financing in exchange for a percentage of ownership. Personal assets include individual or family savings, personal credit cards, or investments like stocks and bonds, or even home equity loans. Equity financing can include using any company retained earnings or fixed assets as collateral to receive loans. The Small Business Administration, or SBA, has two major programs. The 7A program is for general purposes, and the 504 program is for building and major equipment purchases. The SBA is not the organization that actually lends you the money, but they are a guarantor for small business loans. The U.S. Chamber of Commerce is another source of financing and informational help for small businesses. The Chamber of Commerce is present in most cities and is interested in the success of small businesses. Angel investors are investors who provide seed money for the startup and early stages of a company. These investors are putting in their own money, normally between $25,000 and $250,000. They not only provide you with funding, but also mentoring and business experience. Venture capitalists, on the other hand, provide financing during the later stages. They tend to lean towards companies that have a proven profitability record. Lastly, a grant is money that is given to a business that does not have a repayment requirement, as long as the grant funding is used for what is originally approved for. Now, let's take a look at profit. Profit is the amount earned on an investment. There are two basic types of profit: accounting profit and entrepreneurial profit. For the business's financial statements, accounting profit is used. This is what your business has left in revenue after paying off all your expenses. Entrepreneurial profit is different from accounting profit because it is based on the economic concept of opportunity cost. Entrepreneurial profit is the amount earned above and beyond what the entrepreneur would have earned if that person had chosen to invest time and money in another enterprise. Your profitability is measured by using the ratio given by dividing your net profit by your total assets. The ratio can be referred to as the return on investment, or ROI. Therefore, profitability is the return on investment and is related to how efficiently your company's assets are being used in order to generate a profit. The formula is ROI equals net profit divided by the average total assets. The break-even analysis is a very important process for all startup businesses. This analysis is a process that helps determine how many products must be sold or how much revenue must be made before your company begins to see a profit. The choice of using units sold or revenues obtained when calculating the break-even point is based on multiple different factors. This is dependent on the industry, number of sales, or the number of units sold. It is also important to identify these three variables before figuring out your break-even point: the fixed costs, variable costs, and sales in total dollar amounts or price per unit. To determine the break-even point, use the break-even formula. BEC, or break-even quantity, equals FC divided by P minus VC, where FC equals fixed costs, P equals price charged per unit, and VC equals variable cost per unit. When beginning your financial planning process, it is important to start with establishing realistic and attainable goals. It's not enough to say, "I want my company to be financially successful." Instead, specify a specific dollar amount you want the company to reach and the time frame you hope to reach it. Financial goals normally start with capital accumulation. This includes both savings and investments. Once it has been acquired, your financial capital will need to be maintained. The profit margin is the percentage of total revenue that exceeds operating expenses. For example, if you are looking at starting a restaurant, the typical profit margin is normally about 2 to 5%. Your starting point for setting a profit margin financial goal should be comparing your profit margin to the industry average. Cash flow accounting shows you your company's capability to maintain operating capital to cover your basic expenses. Seasonal fluctuations make it difficult for companies to cover cash flow needs strictly out of their sales revenue. This is why securing some type of business financing is vital. Your cash flow goals might include limiting finances for off-season operations or creating reasonable timeframes for paying back any financed amounts. The decision to invest is referred to as a capital budgeting decision. It is also defined as the process of determining which long-term capital investments are worth spending your company's money on based on the long-term potential profit. The word capital in this context means long-term investment. Budgeting refers to the strategy or plan that details anticipated revenue and expenses relative to the investment during a specific time frame. Capital budgeting is seen as a key to your business's long-term stability because capital investment projects are major financial decisions. Capital budgeting and expense budgeting are seen differently, even though they both represent the money your company plans on spending. Capital budgeting involves planning for the long-term future of the company and understanding when an investment will pay back its original cost, while expense budgeting or expenses are often driven by an operational need or requirement. Companies have expenses that don't directly generate a profit, such as your rent, administrative labor costs, or business insurance. Expenses pay back their costs by keeping the business in operation. These expenses are also known as the operating budget. With capital budgeting, there are different types, uses, and effects. Types of capital budgeting include net present value, the rate of return, and other similar formulas. The net present value estimates future cash flows from business opportunities and discounts them back to today's dollar amount using an expected rate of return. This ensures future cash inflows are higher than present cash outflows. The rate of return calculation is similar to the net present value, except it focuses on the interest rate of each decision rather than dollars. Financial planning and capital budgeting often work in tandem. Business owners use quantitative and qualitative analysis before making business decisions. You should combine these methods to ensure that they properly evaluate the financial return of business decisions, rather than accepting opportunities for the sake of potentially growing the business. As a small business owner, you can use financial planning and capital budgeting for obtaining external financing from banks or investors. It's important to have some form of external financing for starting and growing your operation. Since small businesses usually lack a strong financial history, financial planning and capital budgeting is helpful to banks and investors. This way, they get a better view of your commitment to your business. To summarize the capital budgeting process, let's refresh with a quick 5-step breakdown. First, form the proposal to identify the cost and benefits received in after-tax cash flows. Then, evaluate the data to see if the investment will be profitable. Next, make the decision by choosing the option that provides the highest long-term benefit while having the lowest future cost. Then, follow up on the capital budgeting decision with a post-audit to see if the benefits outweighed the costs. And lastly, take corrective action if the post-audit indicates that expectations were not met. Thank you, and best of luck with your entrepreneurial journey.